Hello, everyone. Thank you for being here. Welcome, welcome, welcome. I'm Peggy Beauregard. This is the Nest Egg Builder Show, and I have a little something to read because we have someone talking to us about taxes and other items around that. If you have an important point to make, don't try to be subtle or clever. Use a pile driver. Hit the point once, then come back and hit it again, then hit it a third time with a tremendous whack. Winston Churchill said that. And with that, we have Ralph Walner with us. He's been in his business for 8 years. He works in the tax field and in it's the part that it's sustainable, right? You work in the sustainable area. He's also part of Chamber of Commerce. He volunteers a lot in his community, and he's out there making a difference. And today he's going to make a difference for us. So Ralph, welcome. We're so happy to have you here.
Thank you so much, Peggy. Yeah, like Peggy said, I've been doing tax consulting and specialty tax incentives for businesses for 8 years now. Out of college, I didn't know that's what I was going to do, and it kind of found me. And now here I am 8 years later, really loving it. I actually met Peggy at a networking event right outside of LA a couple months ago now. And I got to plug in with a lot of great people in the network out there. I've been to California many times for tax, but that trip was just very memorable, and I'm glad to be here today, Peggy. Hopefully some of this information lands and makes sense, but if any of it's too high level, or if I go through it too fast, or if you want any further information or have any questions, outside of just stopping me in real time right now and asking, I'll also make sure that you guys have all my all my contact information. But with that said, Peggy, do you want me to go ahead and share my screen?
Yeah, so what we usually do is you do about a 15 or 20-minute presentation, and then we go into Q&A, so everyone does get their questions answered. We love
Perfect.
The curiosity of each and every person that attends.
All right. Well, can everyone see that?
Yes.
Perfect. So I'm going to cover specific tax incentives for energy efficient commercial building owners and developers. It's not just meant for the owners and developers. In some cases, it can also be meant for architecture firms, engineering firms, or really any investment groups, so long as pursuing the incentive makes sense. Obviously, whenever you're talking about tax, you're talking about tax returns. And I know sometimes things can get a little messy depending on how many partners or how many investors, or is it an LLC, or is it a real estate investment trust, or is it a private equity group, and so on and so forth. And so I'm just going to talk at a high level through what the incentives are and how they're captured, and then ultimately just give a couple case studies. I'll do one case study for each incentive I'm going to cover, and then we'll roll right into questions, and hopefully I can answer all of your questions. But again, I'll make myself available at any time if you have any more. So without further ado, so what are these energy efficient incentives? So back in 2006 is when a couple of these were introduced, and then prior to that, lives cost segregation, which I'm sure you've all heard of, but if you haven't, I'll cover that briefly as well. So basically the federal government said, hey, 80% at the time, 80% of commercial buildings in America are using majority of the electricity, the gas, basically our resources are being funneled through at, if you were to compare, residential versus commercial, it was being pumped through commercial buildings. And they were like, how can we incentivize these building owners, these developers, or even just, the current owners to go back in and make these buildings more energy efficient? And so they said, okay, well, what are the main drivers of efficiency in a building? Well, obviously HVAC, obviously lighting, and then obviously the shell of the building. What is it made up of? Is it brick? Is it, just lumber? What's the roof made of? Is it a thick roof? Is it a thin roof? Are the walls insulated? Are they not? And, so on and so forth. And so basically the federal government said, okay, let's create these federal incentives and ultimately let's try to help business owners build more energy efficient and on the back end recoup some of these dollars that they have to spend because it's a little bit more expensive to make things efficient. So the first one, or the first two I'm going to cover, are the 179D energy efficient commercial building property deduction. And then I'm going to cover the 45L energy efficient home credit. And so just at a high level, you can see that the 179D, it's up to $5 per square foot for commercial building owners or designers being architects and engineers. And then for the 45L energy efficient home credit, it's up to $5,000 per unit, or if you're talking about single family homes, it's per home. And that's a tax credit for energy efficient residential properties. And so to break down 179D and even further, the actual deduction itself, so it's a tax deduction being meant for the owners, being meant for designers of public buildings. So if you're an architect or an engineer and you go in and you get paid by a school district or the state, let's say the state of California, they say, hey, we really need these schools built and we need them done next year. And we need them designed energy efficient, as energy efficient as possible. And so the architect draws up those designs. The construction team goes out and builds the schools. They get completed. Let's say they completed this year. Well, now the architect can go back and seek from the state of California who contracted them, which obviously it would probably be a school district, but just for the case of the example, they can go back now to the state of California and say, okay, we did the work, we designed them, they're built, and they're energy efficient just like you wanted. We want to claim 179D. And so architects and engineers can do that on public jobs. So, think anything federal, state, or local, that's where that comes into play. Now, for owners, obviously, that work's going to be private. If I'm a private bank or a private car dealership or anything, I can claim 179D myself. And in that situation, I don't need permission from anyone because I'm actually the owner. So if I build a manufacturing center or a warehouse or a shopping center and so on and so forth, I can claim 179D again, so long as it meets the energy efficient thresholds that are set forth by the federal government. So what are some of the requirements? So it breaks out into the three pieces I kind of mentioned earlier. You'll see either a demonstrated reduction in the annual energy consumption related to the lighting or related to the building envelope or related to the HVAC system. You'll see down in the bottom right corner of this that we look at the requirements based on the ASHRAE standards, 90.1. That gets really technical, but if you know anything about engineering or if you know anything about ASHRAE, basically what happens is every so often the Department of Energy comes out and they say, okay, we're setting forth a new set of ASHRAE standards, and these standards basically set the tone in the industry for builders and for developers, and just for really any property. And it says, okay, this is how efficient things were maybe in 2007, but we want them built now in 2023 to not be against the ASHRAE standard of 2007, but maybe now we want to put the standard a little higher. And now we don't want to build anything like that anymore. We don't want to build anything or use anything that's pre-2012 or pre-2015 and so on and so forth. So really the Department of Energy is coming in and they're saying, okay, all those old HVAC systems or all that old lighting, let's go ahead and get that out of these buildings and update all of it to at least a newer standard of 2012 or 2015 or 2019 or whatever they come out with that year. And so they go in every so often, at least every few years, and update those standards. And those are called ASHRAE standards. And so how much is this worth? So 22 or earlier, we call that the pre-Inflation Reduction Act era, because the Inflation Reduction Act that was signed last year changed things. But pre-2022, you could get up to $1.88 per square foot. Now, for buildings that were completed in 2023, this past calendar year, and moving forward, you can get up to $5 a square foot. So now they're even incentivizing even further and bolstering the deduction even more to really try to get people to spend a little bit extra money making sure that buildings are efficient. So here's just a brief scenario, and then I'll jump into I believe the 45L is the next one I'm going to cover. But this one was a high school, either done, the design was either done by an architect or engineer or both. But this client came in, they designed a 279,000 square foot high school that was completed in 2020. The deduction that it qualified for, which is, on a sliding scale up to $1.88, but this one qualified for $1.80 per square foot. And so they received a 2020 tax deduction of $502,000 for this building. And so what happens then is we take that number, we provide it to their CPA, and their CPA goes ahead and files in this case, it would have been an amended return, and they can go back and now claim this deduction, which is just like any other deduction. They can claim this deduction on an amended return for the $500,000, which obviously a lot of factors go into place, but typically a deduction of this size, especially compounded with maybe a couple more high schools or maybe some middle schools or libraries from that year they might have designed, could generate a pretty sizable refund. And so they can take that money and reinvest, hopefully. So the 45L energy efficient home credit, a lot of it is the same as 179D, but they kind of are an either or. It's either a commercial space or it's a residential space. And so for the residential, it's a tax credit. So you're talking about dollar for dollar here, a little bit more lucrative, but some of the standards and some of the nuances of the actual study are the same. So this one is for the builders, the contractors, and the developers as well. However, they're able to claim the tax credit on residential properties, things such as single family or multifamily homes, townhomes, student housing, assisted living facilities. So 55 and up communities are also qualified for this. And it's a per door, I say per door to simplify it, but per home, per unit, per dwelling. And that's how the credit's calculated. And so this one was the same with the Inflation Reduction Act. It was bolstered, but pre-2022, or so 2022 or earlier, you could get up to $2,000 per unit or per home. Now you can claim up to $5,000 per unit or per home for anything that's completed in 2023 or moving forward. And I'll just throw in a little bit of information. Maybe you remember it, maybe you won't, but these bigger deductions or bigger credits for 179D or 45L, they're actually extended through the year 2032. So a lot of what we're doing right now is not just looking back for previous years, because we can and kind of generate a refund on an amended return, but we're also trying to get on the front and say, okay, builder, developer, we know that you're planning projects right now that may not break ground until 2024 and may not complete until the end of 24 or the beginning of 25. However, just so you know, this 45L credit is available to you, and you can kind of plan. Hey, maybe you weren't going to buy those nice faucets. Now you can. Hey, maybe you weren't going to buy those nice doors. Now you can. Because on the back end, you can claim this 45L credit of up to $5,000 per unit, and you're going to recoup some of those dollars and probably a pretty meaningful amount of money by claiming the 45L tax credit. And so some of what we're doing right now is more sustainability and ESG consulting on the front end and really helping owners and developers kind of financial plan and strategize and tax plan before they even start building. And so I mentioned all of the eligible building types. I won't go through those again, but I do want to talk about some of the requirements and then give you an example of a client that we worked with as well here. And Peggy, if I'm running over time, please stop me, but I think I'm moving pretty fast. So it has to be located within the US. And then one requirement is that it has to be sold or first leased during the relevant tax year. So if it's completed this year, if the building's complete this year, and I move in to this apartment unit this year, then the owner who qualifies for the 45L credit can claim my unit in this year. And so multiply that by the 100 people that move in this year. Now they can claim those 100 units in this year, and so on and so forth. If I moved in last year, then they can only claim my unit for last year. They can't claim it again next year, and they can't claim it again in 2 years. They can claim it one time in the tax year that it was eligible, which is when it was sold or leased. So if it was a home and they built it and I bought it this year and moved in, they can claim it this year. If it was placed in a service or completed before January 1st of this year, then it must have a maximum of 3 floors above grade. So the apartment complexes that are 3 stories or lower are the ones that qualify if you're talking about buildings before this year. However, as of January 1st, there's no, we say the sky is the limit for the 45L credit, but there's no more 3-story threshold. So now it can be 4 stories or 8 stories or 80 stories. You can now claim 45L on residential properties that are higher than 3 stories as well. So before 2023, you couldn't, now you can. And then there's a little bit different set of standards here, but we use a residential energy network called ResNet, and that's what we actually use to model these buildings. So for 179D and 45L, we actually have professional engineers and energy modelers that are also latent employees, just like myself. And we're going to go in and we're going to model these projects just to see how energy efficient they actually are and to see how much credit or deduction they qualify for. And so here's one that was 2 stories. It was 53 units total, completed in 2021. And you'll see that the units were placed into service also in 2021. And I'm assuming that the residents moved in 2021 as well. All 53 units qualified. And so this credit for this property was $106,000. And then I'll roll into cost segregation and cover this just briefly. We always do cost segregation in conjunction with one of these 2 studies. So while we're out at a property, we're making sure to maximize the benefit, look at the building more holistically, and really just take advantage of the time that we have while we're at the building. And so what these do is, this is the assets that you own now. If you know anything about cost segregation, and you've probably been through one of these studies before, you'll know that basically we're just looking at every component of the building and looking at the life left in them and seeing how we can maximize the cash flow by looking at some of the assets and depreciating them as quickly as we can within the next 5 years. And so basically it's a simple but extremely complex process. It involves a lot of calculations, but the good thing is our team does it in-house. We do it in conjunction with either the other credit or the deduction, but basically we're isolating the assets in the building and categorizing them so that we can hopefully increase cash flow as quickly as possible, and do so by increasing the depreciation of the deductions that are available to your company or to the owner group or the investor group or whomever owns the property. And so here's the tax saving scenario there. So we did a cost segregation study. The basis that was left in the building, or the life that was left in the building's assets, was $3.7 million. If nothing had been done, the client could have claimed a depreciation deduction of $91,000. But as a result of our study, the client was able to claim an additional $1.19 million of depreciation in 2022. So this was an after-tax cash savings of $405,000. So the calculation was, at a high level, the basis of the building was $3.7 million. The original depreciation was $91,000. However, the additional depreciation was $1.1 million. And so you'll see that there was a after-tax cash savings of $405,000. And so I'll roll into questions here, Peggy, if that's okay.
Yeah, that's great. I have a lot of questions as usual. Yeah. So if you stop sharing your screen, we can everybody could come raise their hands or whatever they need to do.
Perfect.
Or here we go. So I have a couple questions. So one of them, I'll be going backwards, is you said it had to be 3 stories or more. So it can't be ground floor or 1 or 2 stories to get the deductions now?
So it can be. It just changed to where if it was 3 stories or less, then it did qualify for 45L through tax year 2022 or through
Oh,
calendar year 2022. Now there's no longer a limitation. And so all of those builders who build apartment complexes that are 4 stories, 5 stories, 10 stories, skyscrapers in downtown that are residential, they can take advantage of 45L now as well. So
okay.
originally it was just for the garden style and lower. Now the sky's the limit.
Okay, and is this only for builders, brand new, or is this for people that rehab properties?
Both.
Oh, it is.
So
Okay.
for a builder, it matters who has equity during the build if it's new construction. The 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 people, or I guess individuals or businesses, or whomever has equity during that build can qualify for the 45L. If I buy an old building, let's say it's 10 years old, 15 years old, and I go in and I convert it to residential, or it already was residential, but I go and renovate the HVAC and I have to add a new roof and I've got to add new windows and we've got to re-insulate the walls because the insulation is old. And we've got to do a whole rehab now, update the lighting to LED lighting because those old fluorescent bulbs were just too dim, and so on and so forth. Now the person who came in and rehabbed the property, can claim the credit. And so it's meant for both. It just depends on the scenario. But
Okay.
either way, it can't be claimed until people actually occupy.
Well, what about owners that have a home and they rehab that home? They're already occupying it.
Right. And so typically on a one-off basis,
Mhm.
it really won't make sense, just because doing one home isn't as lucrative as basically doing like our minimum threshold typically, because you talk about travel cost of doing the study and things like that, and just time in general of gathering information and having conversations. We typically like to stay at 10 homes or 10 units or more. Um, it's a requirement that you have an engineer fly out and actually do an inspection. And so you talk about cost of travel, cost of stay, time, things like that. We just want to make sure that the benefit is actually there. Um, I guess you could, if you had somebody local do it for you, you could probably, qualify your own home,
Okay.
or your own building, but, usually we'll do 10 or more.
All right. Good to know. One more question, and then David's got his hand up. The one thing you did not talk about was water. So what about all the gray water and recycling that? I didn't hear one word about water, and I'm in California where the one thing that costs the most, costs more than gasoline, is water.
Right. We don't actually have a water component. Now, in 179D, at least in terms of what we do, in 179D, the HVAC and hot water system are tied in together whenever we do the modeling. So
Mhm.
we do look at some of the hot water piping within buildings that ties into water heaters or boilers, when you're talking about commercial sized buildings. However, we can't take into consideration like chilled water or potable water whenever we're doing these models. We have to input the information in the model, but it doesn't actually help or hurt the qualification. It's just an actual component of the building, so it needs to be modeled.
So nobody's discussing water at all, recycling the water so that it keeps the yard green outside of the building, like say the apartment complex or the office building where it's all green because it's gray water.
Right.
That
That's a
that
great
hasn't even
question.
been brought up yet at all.
That's a great question.
Bring that up to
Honestly,
Congress.
outside of my expertise, I'm not sure about the actual water, groundwater, potable water running through the buildings. I know that they're not built into these incentives specifically. I wouldn't be surprised if that is the case. I live in Texas, so I'm not too sure about California water, but I can imagine that they're probably going to have to do something soon if what you're saying is what's happening. It's, especially if the cost is higher than gasoline. That's absurd.
It may be absurd, but pretty much that's the way it feels. And I read a report a couple weeks ago that said water all over the United States was a resource that needed to be looked at. So you have to run a separate system when you're in a particularly tall building, because how everything works right now is when you're in more stories, they put the black water and the gray water together. So they'd have to run separate for the gray water.
Got it. Got it. Okay. Well, I'm learning now too.
Okay. Hi, David. Welcome. Glad you're here.
Yeah,
Yes.
hi, Peggy. That was actually a great point that I wanted to ask about the water as well, or any sort of retrofitting in the building for any sort of incentives as well. I'm just curious on that.
Yeah. So the component of the building that, at least for our purposes, mostly involves the water is obviously the piping itself. So what we've found, and this is probably all 8 of my years talking to designers and owners, if there is just an upgrade to the piping, or if there's just a redesign of the piping, or if the piping is just pulled out and replaced, then there's no qualification there. If other bigger pieces of equipment that involve heating or chilling of water are replaced, like a chiller or a boiler, or even some of those larger water heaters, or things like that are replaced, then we can probably qualify it at a lower level, maybe not the full deduction, but probably at least a partial qualification. However, just in its own, the plumbing or things of that nature aren't really huge when it comes to modeling for these specifically. And so we haven't been able to capture any deductions for just water or piping or plumbing. And it's just the way the tax code is written. If they ever included plumbing or piping or ADA upgrades and things like that, then absolutely, we'd be going after it and we'd be calculating it all day long. Just right now with the way the tax code is written, it's not a piece of it right now.
Mm.
So what's the minimum number of units that would make sense for you for this program? I'm just curious.
For 45L, 10 is usually the number. We haven't done any studies for folks less than 10 units. 10 units right there, that's $20,000 in tax credits. You calculate in a 20 to 25% fee, just kind of on a sliding average scale, paid back to us. And then you calculate the travel costs, time spent for the clients to provide us with information, actually pretty technical building information in terms of components of the building, different pieces of equipment, things like that. The actual net benefit when you're less than 10 units kind of isn't really there, isn't all that worth it for most building owners. Now, that said, if there are building owners out there or developers out there who, let's say, are building, I don't know, 5 sets of condominiums at the same time, and they're all within the same 10-mile radius, and they're only 5 each. Well, now you're talking about 50 units all within the same general vicinity. And so that works. but we just want to make sure that the net benefit is actually there. We could do the study and we could generate an invoice and we could get paid. We just kind of want to make sure that it's a net positive tax savings scenario for, for them, and that it makes sense for us as well.
What's the difference between the 179 one? Do you need to have a minimum units on that too?
So that one doesn't take into consideration the units. That one's actually just the footprint of the building. And we like to stay above 25,000 square feet. But again, that's just for a single building. If the building is 5,000 square feet, but there's 8 of them, or 5 of them, or whatever the case, then it would make sense to go and do the study for them and capture the benefit. Also, a lot of times, these are just the energy efficient commercial building deductions or credits that we offer. A lot of these owners will qualify for other incentives that Layton offers in-house as well. I know I didn't present on them, and maybe on another show I could, Peggy, but if we're talking about an architect, let's say they design a 25,000 square foot building, and that's their only project that qualifies for 179D. But we know that architects also qualify for the research and development tax credit just because of the nature of their business and their work and their professional staff. Now we're doing an R&D tax credit study for them and a 179D for them. And so that's the beauty of it, right? We offer more than just these incentives. And so typically, whenever we're doing planning with a client and engaging them, we're saying, hey, we know that you qualify for this and this and this, and let's do them all at the same time. That way you're really getting your money's worth.
Thank you. And Cliff.
Hey, Ralph. Great job on the presentation. I do have a few questions.
Okay.
So the first one is, when factoring in the additional cost of upgrading a building to be energy efficient, what is the average immediate net cost impact to the project when using these programs?
Yeah, I mean, we haven't averaged that out because we don't see it enough. So there's so many factors. Like right now, there's a very large architecture firm. They're actually the second largest architecture firm in the world. And they are here in downtown Houston they're doing renovations everywhere. But basically, they're buying a 30-year-old building in downtown. And that commercial building that's used for office space and parking garage underneath is only at 32% use right now, because we all know post-COVID, a lot of folks stopped paying for commercial leases and they moved out, and they realized that a lot of their employees can work from home. And so what they're doing, because the city of Houston is like, hey, we really need something done about these buildings because we still have to keep the lights on downtown, they're taking that building and rehabbing that commercial space into a 26-story residential property. Well, we have to factor in so many things now with commercial lenders, and can we even get a loan on this, and at what interest rate can we get it, and what's the exit strategy, who's going to be able to make money on this. And so right now we're really figuring that out. The immediate tax benefit or the immediate net benefit, I don't have an answer for you right now. I do know that there is a net benefit because it's dollar for dollar on the tax credit side. The deduction side, a little bit trickier because it's a deduction. So you have to factor in the actual business tax rate and, what was your tax rate in 2020 versus what is it now? So the short answer is no, I don't have an exact number for you yet, but I'm sure over the course of the next 18 to 24 months, we'll probably have a lot better idea of what that number is.
Would you know if that's an additional cost, or would you know if that is a net benefit for them financially?
Yeah, I mean, I know just talking to builders, let's say we're talking about single family homes. I've got a client that is out in North Dakota, and they build actual like single family home communities, right? And they're building maybe 400 to 550 homes at a time. So if they, in their geographical area, because that matters, geography matters, if they build all their homes with 2x4s, like literal 2x4s to build the frame of the home and make up with it, they're not going to qualify for the 45L because of their geographical location. 2x4s just aren't efficient enough. But if they build with 2x6s, then they will qualify. But lumber already is extremely expensive now. Building with 2x6s versus 2x4s almost doubles the cost because wood is that expensive. And so I don't know the calculation per home, but I know that they still built with the 2x6s, took advantage of 45L, and saw a net benefit. And so it still made sense for them. We still did the study and so on and so forth. But, you know, I don't know. Everything has gone up. Lumber's gone up and concrete's gone up and paying employees has gone up. So compensation's gone up, and it's kind of hard to pinpoint, you know, where the actual benefit is. But I mean, we're doing a ton of these, hundreds of thousands of homes and units per year. You know, some years we've been up in the tens of thousands of homes. And so, you know, the benefit's actually definitely there.
There's so many different ways that you don't need lumber anymore.
Right.
Yep.
Right.
That are earthquake proof and mold proof, and they're insulated, and you just tip it up.
Right.
That contractors don't want to change how they do things, and they're causing themselves a lot of unnecessary expenses. But hey, that's another subject. Got another question, Cliff?
Yeah, I just imagine that would be really important to know based on the strategy of someone going in. So if they're looking for a construction job and then sell it once it's actually fully developed, you know, if it's not profitable, then it may not be beneficial to go into that. But if it's something that they're doing with a long-term hold where they're actually going to be, you know, managing, you know, the expenses of the property, I could see where that might be a benefit. So I would imagine that information would be important to understand long-term for investors.
Yeah, I agree.
So can you use the energy efficient credit with bonus depreciation at the same time for as long as the bonus depreciation is still available?
So that is a great accounting question. And that's why we work with CPAs. Whenever we talk about just using the credit or just using the deduction itself, first of all, we want to know what entity type it is. So do you have like maybe an example, like, are you talking about maybe like a C Corp, or are you talking about like an investment group, or are you talking about an S Corp? Or do you know?
Well, I mean, a lot of real estate's held in an LLC.
Right. Okay. So for an LLC, let's say it's, I don't know, 5 owners. And we're looking at just they own maybe just one property because they set up one property for every, or they set up one LLC for every property they own. Well, one, our fees at just at a high level are professional services fees. So you can kind of double dip with us. We'll do the study and you can take advantage of that. Factoring in bonus depreciation, I always lean to the CPA. I just don't know enough about accounting as I do about these actual incentives and how to qualify for them. And so what we do, because we don't do any compliance in-house, we do have tax attorneys, we do have CPAs on staff, but we don't do any of the actual filing of the forms or the compliance within itself, is we run all the numbers, we do the study, we create all the reports, and we create everything that the IRS would potentially want to see. And then we provide that to the CPA, and the CPA actually does the filing. And so they're the ones that move around all the numbers. They're the ones that'll do any change of accounting methods that need to be done. They're the ones that'll actually, you know, do the accelerated depreciation if that's what needs to be done. They're the ones that are gonna, you know, switch around the life of the assets, because now instead of taking, you know, the roof over X amount of years, we've now taken it all in year 1, and so on and so forth. So I can't directly answer your question, but that's really where we lean into our CPAs for their expertise.
Okay. And I noticed that you showed the qualified amount changed from $1.88 to $5 per square foot.
Mm-hmm.
Are any of the benefits, and also $5,000 per door, are any of the benefits expected to increase over time until it phases out in 2032?
Yeah, that's a great question. We hope However, I myself have been hoping that just this change would happen for a while. So I started in May 2016, and that was the first time I ever did my first project for 179D. And at that time, the tax code was not permanent for these incentives. It hadn't been made permanent actually until February of 20. It was either 2021 or 2020. I don't know why, I can't remember right now, but that's when the tax code was actually even made permanent. Before that, I was just hoping every year that it would get extended so that I would have a job. Then they make it permanent, and now we can all kind of, breathe. And so it was really cool that they didn't just make it permanent, but then they came in again last year, and the Inflation Reduction Act, they made these bigger. And so although we were hoping they would do it, and we kind of had an idea that they were going to do it, and we knew that the increases in the deduction and the credit were being written in certain bills and certain versions of a different tax code, we didn't actually know it was going to be signed when it got signed. So when it did, obviously we're calling all our CPA partners and saying, hey, this just happened. And they're like, we know. And so, now we're here, and we're just thankful that they did extend it at the increase rate through 2032. I can imagine, probably, I can't say for sure, but I can imagine with the increased focus on energy efficiency, the increased focus on ESG, the increased focus on us just constantly having everything become more expensive, they probably will bolster them and make them even higher. Right now, the cool thing though, just to give you an answer that's kind of cool, and we know it, but not everybody else realizes it, is that now that they took that limitation of 3 stories or less off the 45L credit, you can double dip the 179D and the 45L at the same time. So if it's 4 stories or more, you can take advantage of 179D on that building and 45L on that building. And so now you can potentially get the $5 a square foot and the $5,000 per unit.
Very nice. Thank you so much.
Yep.
Thank you very much.
Yeah,
David,
you're welcome.
David, and then Jana.
Yes, hi. Had a question with you mentioned 10 units and so forth. I'll give you a scenario. If there's a combination of 10 units, it's a portfolio within 5 miles of each other. 2 of the units are fourplexes, which are 2-story, and one's a duplex, which is 1 story. There was several things that were done to the property this year. For instance, HVAC systems, central air ACs, and a couple other things that were added to it. So I'm just curious on that, what kind of credits or refunds and so forth would be given for that.
Yeah, David, that's a great question. So the nice thing is there's a lot we can do here before we actually have to go out there. And one of the things that Layton does, because we don't just make money off doing these specific incentives, is we offer a upfront, completely complimentary, and I mean that, we call it our preliminary analysis or our initial analysis. And so what we're going to do is we're going to send out an ROI request, or a RFI, just a request for information, after a really short call. And we're going to say, look, okay, you've got these 10 units. You say some things were done to them. So will you please send us that information? We're going to pass it on to our energy efficiency team. We're going to have them review the building plans and the equipment upgrades and look at your geographical area, find out what the qualifications are for that county and that state. And then we're going to ultimately say, okay, we know that all 10 units qualify, or we know that only 5 of those 10 will qualify. Then us and you or your client or your investment group or whomever can now make a decision on whether or not it makes sense to move forward. If it does not make sense to move forward and we don't do a study and we don't find you a credit or we don't find you a deduction, then there's no fee. And so that's the part that's complimentary, is we're going to take a look at all the actual information and give you maybe not hard numbers, but a little bit more roundabout idea of what benefit you think or we think you might actually be able to take advantage of for those 10 units that are in that area. And then you can say, okay, this does make sense for me. Or, probably not. Let's try again next year.
Is this more city, county, or is it federal programs?
Oh, these are federal programs. The only reason I mention city and state is because, like for 45L, for instance, and you can go look it up, but please don't. It'll probably bore you unless you really want to, then you can. But there's all these standards that are set forth. And at pretty much at every local jurisdiction level and every state level, they have their own standards as well for energy consumption and what they think is energy efficient. And so we factor that in whenever we're doing our models. One of the first things you do whenever you run a model is you look at how much gas costs in that area. You look at how much water costs in that area. You look at how much heating and all of that stuff costs just in that area. And we put those numbers in a model. And we look at what are the, for that zone of the United States, whether it's zone 1 or zone 5, what are the actual just bare minimum thresholds that a builder has to build to, that they can't build any less efficient than that. And so we factor all of that in from the federal, state, and local level whenever we actually model these projects.
I as I mentioned that I just went through retrofitting a bunch of toilets with all in our units, and I just wanted to know what percentage of the time that what you're studying for, you're actually getting that credit back. Because going through the city, I had a $100 credit for one of the toilets, and the rest of them were only $40. And it's like I gotta spend the time and fight it. It's like, oh my gosh. So I'm just curious, what percentage of those credits, when you go into the studies, you'll actually get versus some other types of credits, I guess.
Yeah, I mean, the nice thing is this is just our day job. So we're going to spend as much time as it takes to find whatever credits there are there and whatever you qualify for in every scenario. We've got, obviously it's not just me, right? A lot of this stuff is a lot of very tax technical, very building technical, engineering technical, architectural technical type work. And so Layton within, as a whole, we're over 3,000 employees globally. And so we're able to tackle some of this pretty quickly just because I get the information. I take a high level look at it and say, okay, this looks like it could qualify. Let me push it off to the team. And we've got multiple teams behind us that are going to look in this information. And within 24 or 48 hours, are going to come back to me and say, okay, green light or red light. If it's a green light, this is what we're seeing. This is what we think they might qualify for. And then we can present that back to you. And so it thankfully doesn't fall on me, and it could never just fall on one person. But like I said, this is what we do. We live in the tax code. We're following the tax code. We're following the updates. We're watching Congress. We know kind of every move they're making because we're monitoring it. And, this is just kind of our, this is our bread and butter. This is what we do.
Okay, thank you very much. Thank you, David. Jonna.
Hey, Ralph, this is really interesting. And you got to my question a little bit with David, but
Okay.
I want to clarify to make sure I'm understanding. And it is in this realm of, today we're talking about energy credits, but you had implied or stated earlier that there are other credits. And so my question is, because we have a lot of people that come into the Nest Egg Builder Show that build and renovate apartments, and I think these services would be very beneficial to them. What other credits could we talk about? What other programs, incentive programs could we talk about here? And then is there a source to go to explore at the federal level, the state level, the county level, the city level?
Yeah, I actually like this platform. This is a really nice, intimate little group, and I'm so glad I'm here talking about this. That's a great question. And one thing that we do, and we're not the only firm that does it, right? But one thing that we do is we constantly push out our own set of webinar series as well. And so, I'd invite you all, those are free. And if any of you are CPAs, or if any of you look for a free opportunity to get CPE or continuing education credits, feel free to tune in to what Layton offers as well. We cover all of that. And we've got YouTube videos that cover all the incentives that we offer in-house. Obviously, we don't offer every incentive in-house because the tax code is like this big and growing. But the ones that we specialize in, we're constantly pushing out marketing materials through our LinkedIn. We're constantly doing webinars, not just myself, but my colleagues as well. Fortunately, we've got a pretty good staff. I mentioned we have tax attorneys, we have professional engineers, architects, engineers. We have biochemists, we have aerospace engineers and former doctors and dentists. And, we've got a pretty robust practice. We cover everything, I always say, from aerospace engineering to agriculture. And so, we cover everything between the ground and the sky. And we just find incentives that we think are lucrative enough for businesses or owners or developers to take advantage of. And obviously for us, we find a way to monetize them, but we find a way to monetize it in a way that makes sense, that the actual taxpayer is getting more benefit than we are, for sure. We're just trying to create net positive tax saving scenarios, and then ultimately provide education and awareness around this stuff. Obviously I'm not getting paid for this presentation, right? But it's important that all of you know about this, especially if you're in this space or you're investing your real hard-earned money and dollars into this type of stuff. It's just important to know that this benefit's out there. And so that's what we do. It's an education and awareness thing. We constantly go to conferences. I'm going to be in DC at a national tax conference put on by the AICPA on November 13th and 14th. And we'll have a booth set up there, and we'll be talking about this stuff. We'll be sharing about this. My office, I'm in Houston right now, but my home office is in Boston. We're constantly networking around Boston and Massachusetts and down here in Texas and out in California and really everywhere. And so, that said, on Layton's website, all of the stuff that we offer is there. We do things for state and local tax. We try to help with federal and state grants, capturing those for really any industry. We do the R&D tax credit. I mentioned that one earlier. A lot of people took advantage of the employee retention credit. We did a lot of those as well. We actually did almost 4,000 employee retention credit studies, kind of whenever it was a big thing. And so, we're just seeing where it makes sense for businesses to take advantage of these deductions and credits, and I'm helping them capture them.
It's great. Thank you. Anything else, Jana?
No, I like this subject a lot. I think it adds a lot of value to a lot of people. And so I'm just I'll check out the website and see what else I can learn.
And you too.
Thank you.
Great. Does anyone else have any questions or comments for Ralph?
I do. I don't mean to hog the whole meeting, but yeah, Ralph, this is great. I know we're talking about apartment buildings and so forth. What about mobile home parks and storage facilities? Just curious if there's anything available for that.
So for manufactured homes, pre-2023, and I don't know what they changed, because we don't have many manufactured homes, like trailer home specifically clients. I don't have any. I might have colleagues that do, but I don't have any personally. But I know for manufactured homes, I think they were able to get up to $1,000 per home, but they've got to be like really efficient. Almost basically they've got to be brand new. Anything after brand new probably isn't going to qualify. And it's hard to find, like most, I think for the most part, they're just called trailer parks. But for most trailer park owners, they don't actually own the trailer itself. And so it's usually, at least from the studies that we've been like proposed to do, it's been really hard to find any benefit, because even if the trailer park was, let's say, 50 trailers or 100 trailers, they might only own like 10 of them. And so it just didn't make sense. because they weren't even the ones like living in them, and maybe the tenant didn't want to actually let us in there. I mean, it's a pretty hairy situation. There is a qualification there. I've just never personally done some. But you know, it's still there, and there's still an opportunity. And if you have something you think might make sense, I just actually put my email in the chat box for everyone. So hopefully if you saw that, jot down my email, and send me any questions that you have. You know, we're more than happy to take a look at them.
Thank you. Appreciate it.
Well, there's a lot of build to rent people, and they are using manufactured homes because they're built better, and they can just bring them in and set them on the foundation that they've prepared.
Right. Yeah. The manufactured home thing is tricky. Like if it's all made in a factory, then then it gets really tricky with like prefabricated materials, prefabricated homes. But you know, like I said, our whole tax team still will take a look at it, and we'll give you a green light or a red light before we start, you know, engaging anything or accruing any money. That part is just complimentary.
Okay, great. Well, we are at the top of the hour, and this has been really a great presentation, Ralph. We really thank you for coming and educating us. We always appreciate that. And this would be a good conversation to have with whoever your tax advisor is now. You know, we are at the end of October going into November, so you really should make sure that you are in the right position for your end of year taxes. And this is a good discussion to have if you're doing any of these incentives. So thank you, Ralph. We'd love to have you come back again.
Yeah, thank you, Peggy. You know, I can bring on any experts as well. We can talk about other stuff that we offer. So I'll send you some more information on the services Layton offers, and you know, hopefully we can just help spread awareness on some of those.
That would be great. Thank you very much.
Thank you. Thanks everyone for the questions.